They tell you the government is borrowing money from investors, from markets, from the public. But here's the uncomfortable part no one likes to say out loud. A huge share of government debt is borrowed from itself, not metaphorically, not indirectly, literally. And once you see how that works, the entire idea of public debt starts to feel very different. Because the money doesn't disappear. It doesn't go where you think it goes. And it definitely doesn't behave the way the headlines suggest. So tonight, let's slow this down and walk through it. Not like a textbook, like a system built over decades that now quietly shapes interest rates, inflation, pensions, and political power. And it matters right now more than ever. Because governments are borrowing at levels that would have been considered unthinkable just a generation ago. And they're doing it in a world where the line between borrower and lender has almost vanished. Here's the cold open most people never hear. When a government borrows, it issues bonds. Those bonds promise interest and eventually repayment. So the obvious question is, who's lending the money? The popular answer is investors, foreign countries, banks, the market. That's true, but it's incomplete. Because in many major economies, the largest buyers of government debt are institutions that are either created by the state, protected by the state, quietly backstopped by it. Central banks, public pension funds, national insurance systems, state-linked financial institutions. Which means a large chunk of government borrowing is really the government owing money to parts of its own system. That's not conspiracy. That's accounting. And once you understand that, the story changes. Let's make this concrete. Imagine a government needs $1 trillion. It runs a deficit, spending exceeds taxes. So it issues bonds. Now, who buys them? A pension fund does. Because it needs safe assets to match long-term retirement promises. A central bank does. Because it's trying to stabilize markets or manage interest rates. A public insurance program does. Because regulations say it must hold government securities. All of those entities are technically separate, legally independent, operationally distinct. But zoom out. They exist because the government created them. They operate under rules written by the government. And if they fail, the government steps in. So the left hand borrows, the right hand lends. And the system applauds itself for being stable. Here's where it gets interesting. When the government pays interest on that debt, where does the money go? Back into those same institutions. Interest paid to a central bank, often returned to the treasury later as remitted profits. Interest paid to pension funds, used to pay retirees who depend on government guarantees anyway. Interest paid to public institutions, circulates inside the system. So the debt exists, the payments move. But much of the money never truly leaves the public balance sheet. It's like writing yourself a check and congratulating yourself for making a payment. This is where the language starts doing a lot of work. We talk about debt servicing, as if it's a crushing external burden, as if creditors are standing outside the gates, demanding tribute. Sometimes they are, but often they're already inside the walls. Now, this doesn't mean debt doesn't matter. That's the trap. It matters a lot, just not in the way people usually think. Because the real tension isn't default, it's distortion. Let's talk about central banks. Over the last few decades, central banks have become some of the largest holders of government debt in the world. They buy bonds to lower interest rates, to inject liquidity, to calm markets. Officially, this is temporary, technically reversible. In practice, it's become permanent infrastructure. And here's the quiet irony. When a central bank buys government debt, the government is effectively borrowing money created out of thin air. Not taxpayer money, not foreign capital, new money. That doesn't mean it's free. It means the cost shows up somewhere else. Inflation pressure, asset bubbles, wealth inequality. Because that money flows first into financial markets, then into asset prices, and only later, unevenly, into the real economy. So while politicians argue about deficits on TV, the deeper consequences unfold silently. Now add pensions to the picture. Public pension funds are massive buyers of government bonds. Why? Because they're told to prioritize safety. And nothing is considered safer than government debt. But here's the paradox. The government borrows money from pension funds that depend on future government support to remain solvent. So the state promises retirees money in the future, then borrows money today from the institutions meant to pay them, and promises to repay that money with interest using future tax revenue. It's a time loop. As long as the economy grows and confidence holds, the loop works. But it leaves very little margin for error. This is where the math becomes uncomfortable. As debt grows, interest payments grow. Even if interest rates stay low, the sheer size of the debt means servicing costs expand. So governments face a choice they rarely state clearly: raise taxes, cut spending, inflate away part of the burden, or keep borrowing from the same internal system. Guess which one is politically easiest? Borrowing from yourself feels painless. No angry bond vigilantes, no immediate tax hikes, no visible crisis, just numbers moving between accounts. Until something breaks, and what usually breaks isn't the bond market, it's trust. Because once investors, internal or external, start doubting the long-term stability of the system, the rules change fast. Interest rates rise, central banks face losses, pension assumptions fall apart, and suddenly, that cozy internal loop looks very fragile. This is why debates about interest rates are so tense now. Raising rates doesn't just fight inflation, it increases the government's own borrowing costs. It creates accounting losses at central banks holding long-term bonds. It stresses pension funds locked into fixed income portfolios. So policymakers are trapped in a strange position. They must control inflation, but they can't raise rates too aggressively without destabilizing the very institutions financing the state. It's not a conspiracy. It's a feedback loop. Now zoom out. This system didn't appear overnight. It evolved slowly as governments looked for stability, flexibility, and control. Domestic ownership of debt reduced reliance on foreign creditors. Central bank purchases calmed markets during crises. Pensions needed safe assets. Each decision made sense in isolation. Together, they created a world where governments owe most of their debt to entities that depend on them. Which brings us to the biggest misconception of all. People ask, who will pay for all this debt? The uncomfortable answer is the system itself. Through inflation, through suppressed returns, through slower growth, through political trade-offs that never make headlines. The cost is real. It's just diffused. And that diffusion is why the system survives. For now. So the next time you hear that a government is borrowing from the market, pause. Ask which market? Which institutions, and how many of them ultimately trace back to the state itself. Because once borrowing becomes internalized, debt stops being a simple IOU. It becomes a tool, a constraint, and a quiet source of risk. not because it will explode tomorrow, but because systems that borrow from themselves rely entirely on confidence that tomorrow will always be manageable. And history has a habit of reminding us that confidence is not a guarantee. So here's the unresolved question to sit with. If governments are increasingly borrowing from themselves, who, exactly, is left to discipline the system when it goes too far? And what happens when the borrower and the lender finally disagree?